When they report earnings, they're giving you the current price action or the current earnings of that company. The smart money says, what are they going to do in 6 to 12 months? And let's position ourselves there. Because remember, smart money has literally billions of dollars in these stocks or in anything. And so they can't on a dime just say, hey, let's sell our $5 billion of NVIDIA, right? They can't do that. They have to do it ahead of time. They have to start working out of positions. And the markets, I don't care if it's crypto, if it's stocks, what you see is investors position themselves based on 6 to 12 months out. That's just what they do. That's how we work. We always position ourselves for the next move, not the current move.
Unit labor costs, a gauge of wage inflation, rose at a revised 2.2% annual rate in the second quarter, up from the initial estimate of a 1.6% pace, the U.S. Labor Department said. The government released revised productivity data that comes after U.S. GDP growth in the second quarter was revised down to a 2.1% annual rate from the initial estimate of 2.4%. The unemployment report for August released last week indicated strong hiring with gradual softening in labor, said Michael Ferroli, chief U.S. economist at J.P. Morgan Chase. There is still no sign that companies are laying off workers. All signs seem to point to higher claims, and yet they fell to the lowest level in nearly 7 months. The claims data do not show any real evidence of a pickup in layoff activity. There have been brief periods of elevated counts during 2023, specifically in June, but these periods have been short-lived and often explainable by special factors, said Tom Simons, money market economist for Jefferies. Gareth Soloway in this video dives into these key metrics, stating that the Fed wants more low numbers to stop hikes, but it seems like the numbers are not coming in. He also went further to analyze the dollar chart, crypto, and other stock market indicators, stating the similarities and changes that occur with various economic news and how investors can benefit from making trades on them. Let us now join Gareth as he explains these concepts. Also, don't forget to hit that like button, subscribe, and drop your comments below.
So what we can see here very clearly, guys, take a look at this. We see this news coming out this morning. U.S. unit labor costs higher in the second quarter than initially thought. What does that mean? Let's translate that. Unit labor costs. Costs are inflationary. All right, so right off the bat, that's an inflationary headline. That's inflationary economic news. So that is a very important point here. The reason why that's important, folks, is because, again, the only way the Fed can stop raising and start lowering interest rates, which is what the market craves, is if we see inflation continuing to come down. Lately, we've seen oil go up, and oil again, nearing $90 a barrel. We've seen gasoline. We've seen other costs going up, and that is putting a major cramp in the Federal Reserve's ability to cut these type of things. All right, another thing, check this out. Employment claims. All right, employment claims coming down. And this is a wild one, folks, because even I'm surprised at this. Now, whether this is because of August and it's just a dead month and people are like, hey, I'm going to hang out with the kids until we get into September. Because remember, this is from last week. So again, this is mostly that kind of holiday week going into Labor Day. So it's possible people just said, you know what, I have to file for unemployment, but I'll wait till after the holiday. I'm not going to worry about it now. That is a possibility. But check this out, guys. All right, we saw the number come in for people filing for unemployment at 216,000. The expectation was for 230,000. Okay, so again, a much lower number of people filing for unemployment. That generally speaks to a stronger economy. All right, now again, like I said, maybe it had something to do with the holiday. We'll know next Thursday when those next numbers come out. But again, it was the lowest number since February. And that's something important to keep an eye on because here we're looking for weaker economic news. The market wants weak data. It wants bad data. Bad data right now puts the Fed on the sidelines. It means hiking is over. We're not seeing that. So the November rate hike, which again, the markets are kind of 50-50 on, now after the data today and the unit labor costs could be starting to spike just a little bit in terms of expectations.
Federal Reserve pricing now suggests a 52% chance of a hike at the November 1 meeting, up from 40% earlier in the week. The jump comes after a surprisingly strong ISM Services survey showed an acceleration in August, including in prices paid. The index rose to 54.5 from 52.5, while the pricing measure hit 58.9 from 56.8. The market is grappling with how high Fed rates will go and how long they will stay there. Fed officials have signaled that they will leave rates unchanged this month, but we'll be watching the data to decide on what's coming next. Some numbers have begun to moderate, but the ISM services sector is a great forward-looking indicator and suggests there is still some strength.
Here we have the US dollar, and it is climbing. This is the Dixie, and this is the daily chart, right? So I put in my trend lines. I want you guys to be all kind of focused on the trend lines here. But here we clearly see that the Dixie continues to move up. It is higher today. If I zoom in, I'll show you here. The dollar, again, on the back of this news, is going higher. So here you are, right? This is today's candle right here, and that, again, is moving up. Now, again, I'm a skeptic. I think that we're closer to the end of the dollar run than the beginning. But again, news like today, you're watching for the price action. And I'm going to tell you this, guys. When you see good economic news and the dollar actually reverses, that's a signal of a top. It's kind of like what we're seeing in Bitcoin right now, where in Bitcoin, we see how good news continues to be a sell-off factor, right? So going to yesterday, this is the 10-minute chart on Bitcoin yesterday. We did see this big pop on an intraday basis when ARK Invest filed for an ETF for Ethereum. But look at this is the 10-minute chart. So literally you had this, it was breaking down, and then Bitcoin surged on the back of that news, and then literally within 20, 30 minutes, it gave up the entire gain. We saw that with Grayscale. Within 2 days, we gave up the news on Grayscale. Ripple within 1 day. And again, this is the type of stuff that tells you as a price figure that price action is still bearish when it can't hold good news gains. On the other side, when we go back to the US dollar, that's something I watch for as well. So in this situation, we are seeing the dollar actually starting to pull back. So again, this is something I pay attention to, right? Think about it. All it is inverse, right? If you're rooting for the dollar to go down, or even if you don't care like me and you just want to be able to trade it, you have to look for these signals. So what did we just see on the Bitcoin chart? Bitcoin generally has been bearish because every time it gets good news, it pops, right? It pops, and then it reverses that move to the downside, okay? Now here on the dollar, and this is still early in the day, but here we had that news, the good economic news, the dollar popped on the 10-minute chart, and look at what's happening to the dollar right back down. So that's something that I'm going to pay attention to. I'm not going to say it's anything significant yet, but again, as I said, based on my analysis, there's far too many people now bullish on the US dollar, and that concerns me as it usually signals a top. In addition, if you go to the daily chart of the US dollar, look at the run the dollar's had. I mean, in all fairness, if you look at this chart, this is a chart that probably is getting closer to the end of its run than the beginning, and that's what we're going to see. Maybe it gets up here, which is just a little higher, about 50 cents higher on the Dixie, but either way, to me, this is starting to look like an extended chart. All right, next we take a look at the 10-year yield. Now, this is another important one. All right, now, the bond market is known as the most important market out there. It's the biggest market in terms of money. You might think the stock market's bigger, not even close. The bond market is way bigger, and when you hear about smart money, when someone says, hey, where does the smart money play? The smart money plays in the bond market. That's just the facts of it. It's more money, it's bigger institutional money. That's where it is. So what you also want to do is you want to look at the 10-year yield and see what that's doing. And essentially what I'm doing is I'm trying to take you through my mindset of when I get economic news, I see, okay, the media is telling me that expectations were here, we came in here, or we came in here. Now, what do? My first process is to look at the US dollar right now, then the 10-year yield. And what I'm doing is I'm not going by what the mainstream media is telling me, what people are telling me, oh, this was a good number, this was a bad number. No, I go to the actual price action. And the price action will tell us more about it. Because what this can tell you is if yields, and by the way, yields were popping to 4.29%, now they're starting to come back in. If yields start to fall, what does it tell us? It tells us that smart money in the bond market does not believe that the jobless claims numbers that came in stronger or unit labor costs are anything significant, and in fact, they're expecting an economy that's going to weaken, and therefore rates would come in. You see what I'm saying here? How you kind of don't want to just look and say, this is the same thing with earnings, by the way. A good example of this was NVIDIA, right? So NVIDIA, we know that NVIDIA had these great earnings. The stock was up after hours a mile, up to $520. The next day it fell and closed at like $470. It was basically flat on the day.
In a characteristic warning to investors, Morgan Stanley's Mike Wilson has bad news for the stock market. The staunch bear wrote in a note on Tuesday he believes economic growth will be lower than estimated, disappointing U.S. equity investors hoping to see indexes soar even higher. Indeed, the S&P 500 has enjoyed a surprisingly strong 2023, up 18% for the year to date, while the Nasdaq is up approximately 43% for the year to date at the time of writing. Many investors are expecting the good times to keep rolling after tech stocks were buoyed by recent buzz around AI, and the economic outlook began shoring up as the Fed's rate hikes began bearing fruit. Likewise, in June, the Fed released its predictions for U.S. economic growth to, albeit by a small amount, avoid a recession. The consensus across Federal Reserve Board members and Federal Reserve Bank presidents is a median of 1% in 2023, 1.1% in 2024, and 1.8% in 2025. The chief U.S. equity strategist for Morgan Stanley explained his point further during his Thoughts on the Market podcast this week, saying the market often fails to realize that a trend, be it gains or losses, isn't a guarantee for the future. Wilson said the move higher in stocks this year has provided the confidence for a bearish consensus at the start of 2023 to switch to a fundamentally bullish outlook. It's human nature to want to go with the trend both up and down, Wilson reasoned. The entire move in the major U.S. equity averages this year has been the result of higher valuations, he explained. However, with forward price earnings multiples reaching 20 times on the S&P 500 last month, not only are stocks anticipating higher earnings and growth, but they now require it. This necessity is a warning Wilson has offered before, saying in February that share prices are in the death zone where investors simply cannot afford to back out of dizzying stock prices and are instead hoping their portfolios will survive without catastrophic consequences. What do you think of Gareth Soloway's analysis? Are you positioned for the next bull run? Let us know in the comment section below. Don't forget to like, subscribe, and hit that notification button so you are the first to know about our new videos. Thanks for watching.